Welcome, finance leaders, to this explainer. Today, we're going to talk about transforming your legacy payment operations into a modern, totally frictionless powerhouse. Whether you're leading procurement, managing treasury, or overseeing the entire financial health of your organization, the way your money moves is honestly just as important as how much money you make.
I want to start off with a number that should make every finance professional pause for a second. 63%. According to the 2025 AFP Payments Fraud and Control Survey, a staggering 63% of organizations faced check fraud in 2024. Seriously, think about that. If you're still relying on paper checks and manual processes, you aren't just being inefficient, you are carrying a massive, highly targetable liability.
So, I've got to ask, is your finance tech stack stuck in the past? Just think about the consumer world for a minute. We all love that seamless, one-click checkout experience we get online, right? But then we come to work, and the reality of B2B invoicing hits us. It's painful, it's highly manual, it's totally disconnected. It feels like we're living in two completely different financial eras. Okay, let's dive right into this playbook. Here's what we're looking at today. 1. The B2B payment ecosystem. 2. The cost of legacy systems. 3. The embedded finance shift. 4. The rise of virtual cards. 5. Automating data and reconciliation. And finally, 6. Future-proofing payment operations.
All right, part 1, the B2B payment ecosystem.
Before we can even talk about modernizing, we have to understand the basic plumbing. The terminology often gets tangled up here. People think a payment gateway and a payment processor are identical, but they actually play really distinct roles. The gateway is basically like the front door. It takes the data, encrypts it, and just passes it along. But the processor, they act like the digital postal workers of the system. In a matter of high-stakes milliseconds, they handle the data orchestration, the direct network communication, and they manage the real-time logic to determine if a transaction gets approved or declined by the bank.
And that brings us right to the bedrock of the entire card ecosystem, the four-party model. Step 1 is the merchant, so the seller. Step 2 is the acquirer bank, which is the merchant's bank. Step 3 is the network, think Visa or MasterCard, connecting everyone together. And Step 4 is the issuer bank, which represents the buyer. This very specific orchestration of authorization, clearing, and settlement ensures that a digital payment flows consistently and securely, whether you're doing business in Azerbaijan or Zimbabwe.
Moving on to Part 2, the cost of legacy systems.
Now, while the underlying infrastructure is standardized globally, the way businesses actually use it is, often deeply flawed. The gap between consumer simplicity and B2B complexity is just incredibly jarring. B2C payments are instant, straightforward, and generally involve just a single stakeholder. But B2B transactions, you're dealing with massive sums of money, payment terms extending 30 to 90 days, intense regulatory compliance like KYC and AML, and just so many layers of stakeholders. That extended float period alone creates massive cash flow headaches, and the compliance layers, they just create frustrating operational bottlenecks.
And this brilliantly illustrates why the risks of sticking to the past are just immense. If your team is still doing manual spreadsheet reconciliation, paying absurdly high wire and check fees, dealing with really opaque foreign exchange rates, and operating in completely disconnected procurement silos, you are literally draining productivity. And as we mentioned right at the start, paper checks are basically an open invitation to that 63% fraud rate we talked about.
Which leads us to Part 3, the embedded finance shift.
Thankfully, there's this macro-level paradigm shift happening right now to rescue us from these legacy headaches. Financial services are actually merging directly with non-financial software platforms. Take a look at this breakdown from Bain & Company. The traditional bank-driven value chain is shifting to a totally new ecosystem with 4 main participants. You've got the end customer, the software platform that actually owns the relationship. So think of a Shopify or a MindBody. Then the financial services enabler, like Stripe, providing the tech. And finally, the regulated entity, the actual bank that holds the balances. This is what we call the better together proposition. It gives the customer a beautifully streamlined experience right inside the software they already use, all while drastically cutting costs and reducing risk for everyone involved.
Now, what's really interesting about this slide is the sheer scale of where this is heading. Just look at that massive red block showing projected growth for B2B payments by 2026. The total U.S. market for platforms and enablers is expected to more than double to $51 billion, with transaction values surging to $7 trillion. To put that into perspective, that validates the absolute urgency for your organization to adapt. The market is moving, and it is moving fast.
Let's get to the good stuff. Part 4, Rise of Virtual Cards.
So how do you practically tap into all this modernization? Well, if your accounts payable department needs an immediate, highly effective upgrade, virtual cards are honestly the true hero of this playbook. I really want to highlight this quote from Ralph A. Kaiser, the CEO of UATP. He says, "Virtual cards and payment orchestration offer particular promise for organizations ready to move beyond legacy systems." This isn't just some passing industry buzzword, guys. Virtual cards represent a fundamental shift in how you control corporate spend and finally eliminate the technical debt of paper checks and manual wires.
And the momentum here is completely undeniable. Juniper Research projects that the B2B virtual card market will surge to $14.6 trillion by 2029. That represents 83% of the total virtual card market globally. This incredible surge is being driven by a huge demand for digital-first APIs and the unparalleled security of single-use tokenization.
What makes virtual cards so incredibly powerful is that it's a true win-win scenario. For the payer, so your AP team, you completely mitigate fraud. You basically generate a unique 16-digit token for a very specific amount that can only be charged one time. Bottom line notes that while checks face a 65% fraud risk, virtual cards sit way down at just 9%. Plus, you can earn cash rebates and set really strict spend limits. And for the vendor, they get to end the absolute nightmare of manual check processing, they speed up their access to funds, and they receive rich, detailed remittance data that makes their own accounting an absolute breeze.
All right, Part 5, Automating Data and Reconciliation.
Because moving the money is only half the battle, right? Knowing exactly what that money was for, without having to chase down invoices or match spreadsheets line by agonizing line, is the critical back end of finance operations. So the crucial point here is the underlying data format. Legacy Swift messaging relies on decades-old, unstructured formats that practically guarantee you're going to need manual intervention, but enter ISO 2022. This new global messaging standard fundamentally changes interoperability. It carries rich, structured fields, tax codes, purchase orders, invoice numbers, right alongside the payment itself. It brings total transparency to cross-border transfers and allows payments to be automatically matched to the exact right transaction. It's a real game changer.
When you combine that standard with today's automation arsenal, the magic really happens. We're talking about Swift GPI, which gives you real-time tracking. It literally acts like a FedEx tracking number for your funds. We're talking about APIs linking payment statuses directly into your ERP system so you never have to log into 4 different bank portals ever again. And virtual IBANs, which automatically sort your inbound payments by specific customers or geographies. This whole setup entirely removes human error and manual tagging from the Treasury Department. No more guessing games.
And finally, Part 6, Future-Proofing Payment Operations.
As we look at the imminent horizon, understanding what to prepare for is absolutely vital. Trace this timeline with me. We know the baseline. 2024 saw a huge check fraud vulnerability. Right now, in 2025, we're seeing mid-market virtual card adoption spiking really aggressively. Next year, in 2026, Juniper Research highlights that agentic AI and stablecoins will begin dramatically reshaping B2B commerce and settlement layers. By 2027, ISO 2022 will totally dominate Swift cross-border payments. And by 2029, as we said, that virtual card market is going to hit $14.6 trillion. The migration away from legacy rails isn't just happening, it is accelerating exponentially.
Which leaves us with one final, absolutely critical question. Are your payment operations ready for 2026? The gap between the businesses operating on intelligent, automated networks and those still writing paper checks is widening every single day. You need to centralize your tech stacks today, embrace orchestration in virtual cards, and make sure you aren't left holding paper checks in an AI-driven digital economy. Thank you so much for joining me for this explainer. Now go modernize those payments.